All right, welcome to the Investor Financing Podcast. We got another great guest. We're going to deep dive on the three C's of raising capital. We're going to talk about marketing. We're going to talk about investor clubs. We're going to talk about the differences between multifamily and single family investing, and really building a platform so you can grow your business. So please welcome to the show, John Casmon. He is a multifamily real estate entrepreneur and marketing maven with extensive experience collaborating with others to deliver profitable results. Hosts the popular and growing real estate podcast Target Market Insights and hosts the Chicago Multifamily Club. Co-created the Midwest Real Estate Networking Summit, partnered with investors on over 900 units in multifamily valued at nearly $90 million. Welcome to the show.
Hey, Beau, thank you for having me. I'm excited to be here and can't wait to just jump into things today.
All right, awesome. So when did you get into real estate? Has this been kind of you were an employee at some point and you said, oh, I want to, or are you still an employee, or how did you get into the multifamily space? Were you a residential investor, or did you just jump into multifamily?
Yeah, so I was working in corporate America, like many of your listeners, had a W-2 job, and at the time I was actually in Detroit. And what ended up happening, the short story is, I worked for General Motors, and if you recall, 2007, 2008, 2009. I was there during that time frame, and we ended up, going into bankruptcy. And at that moment, I just remember the anxiety that I felt, a lot of my colleagues felt, not knowing what was going on with the world, our company, the financial crisis that just hit, and really feeling like I needed to take some control over my financial future. And I thought back to Rich Dad, Poor Dad, which I had read some years before, and it really just made me think about, how do I get more control? Well, real estate is one of those vehicles that allows me to do that. Again, I was in Detroit at the time, and the market was crazy, and everyone I knew who had real estate was trying to fire sell it to get out of it. So it didn't feel like the right time to be investing in Detroit, but I ended up moving to Chicago in 2011. So I moved there really with the focus on starting to build out my own portfolio. So I had some other means of income outside of just the W-2. The next year we did a house hack. I got married. My wife and I bought a house hack property. 2 years later, we bought a 3-unit building, refinanced that first property, bought an 8-unit building, started flipping some properties. And then essentially about 5 or 6 years ago, made the decision to really start scaling into larger multifamily. And in doing that, I knew I would need to start partnering with other people and raising money, because I was certainly running out of all the capital that I had with the deals that we were doing. So that's really how I got started. And it really comes back to, really solving that first problem, which was, I was in an environment where all I had was my W-2. I watched what it was doing to my colleagues. And while I didn't lose my job, the stress and the anxiety and the super real reality of, hey, I could lose my job at any moment. It forced me to say, you know what, you better go find something else. Otherwise, this could be your future at any moment.
Yeah, I think that's a rude awakening for a lot of people, and it's good you had that, and at an early age, because there's a lot of people that are in their 50s and 60s and they're thinking, oh, there's got to be a better way. And that's why we do these shows, is really, hey, there is probably a better way to do it. So you progressed, you did your house hack, you did your triplex, then you did an 8-unit, and then you realized, okay, well, in order to grow, we need to team with other, or do joint ventures, and then you probably learned about syndication, and then you started looking at bigger and bigger properties. And so it's like an evolution. I hear this story over and over again, but really, where were your strengths, like as an investor, that you like kind of grasped to, that you said, I'm a good marketer. I know how to talk to people. How do you use your strengths, I guess, to really grow? Like, how did you kind of formulate the plan to, like, okay, I'm here right now. I know I need to go raise capital and look at bigger deals, learn how to underwrite bigger deals. How'd you progress into that stage?
Well, that took some time, because I was very hesitant on reaching out to other people and asking for money or asking them to invest with me. So that was the wall I had put up. And essentially what happened is, as I was building my own personal portfolio, one, we were saving up all of our money to buy something. So the moment we bought a property, we were pretty much back to zero in our bank account. And then we had to save, we had a little money for reserves, but we had to start that saving process all over again. So when we did it on the 8 unit, I remember feeling a little bit dejected because while I got my first commercial property and this was the largest deal we had done up to that point, we had over $1.5 million, dollars worth of real estate in our portfolio. It should have been a joyous, occasion, but all I could think about was, man, now I got to go back and try to save another 6 figures before I could even go shopping for another property. And we were building equity, but it wasn't like we had the cash flow where if I did lose my job, I wasn't worried about it because I had plenty of cash flow coming in. So there was a bit of an imbalance based on my goals, right? Again, my goal was always to insulate myself from the W-2 job. So if I lost it, I wasn't concerned. But in reality, I was just building up a large equity play. We're at these properties, we had a lot of equity in them, but my cash flow was just okay. It wasn't enough to be able to quit my job or to live off of. And I think at that moment, I realized there had to be a better way. I really started talking to other people who were having success. I had a friend that went from 9 units to 90 units. And I sat down with her and just said, hey, how'd you do it? And she told me, hey, I had to bring on partners. And this is how we structure the deals. And this is how we do it. So that really warmed me up to the notion of working with other people. Going back to kind of your question of what skills did I bring that helped me make that transition, it took a minute for me to realize that apartment investing and commercial investing, it's another business, just like any other business. And because I spent 15 years in corporate America doing advertising and marketing for the automotive industry, food and beverage brands, a little bit of insurance and all sorts of other brands and companies, apparel, shoe brands and whatnot. Once I realized, okay, wait a minute, this is just like any other business, and all businesses have the same functions. You've got a human resources department, you've got, product or product development, you have a sales and a marketing team, you have operations. And when you understand like every business really has those same functions, now it's just a matter of figuring out, well, what do you do? And my background in that advertising and marketing world was really on the account side, account management, interacting with clients, or when I was on the client side, working with my project team, overseeing the project management and make sure that, what we needed to get done was being done in an efficient and effective manner. So those skills really are transferable. If you understand project management, it doesn't matter if you're overseeing, the timeline of a TV production or a print ad, or if you're overseeing a construction project. Sure, you might not know how much, carpet costs per square foot, but that's an easy thing to figure out. And quite frankly, you don't need to know how much it costs. You need to understand, hey, here's what the quote is, here's what the bid is, here's the timeline, here's what time the carpet people are installing, and making sure that project is moving swimmingly. So a lot of those skills are transferable. And when you understand that, it gives you a little bit more confidence to take that next step and move forward.
Yeah. Yeah. So will you kind of walk us through? Well, first of all, I love, I always think, I listen to Gary Vaynerchuk, and Gary V says we're all media companies, right? Like you got to think of yourself as a media company. And instead of lending, I should have probably been in marketing, because I love marketing. I love like reverse engineering, like for my loan business, for example, like putting out podcasts and talking about SBA. People start finding me. It's just amazing. But you can really use these skills in any business you're in. And I like how you looked at the multifamily. It's like, it is a business. You got to take it seriously. Like you can't just dabble in it. You're raising capital. You got to protect your investors' capital. So on your first deal, your first bigger deal, was that a joint venture? Was it actually syndication? And
It was a
did you?
syndication, and it's crazy because if you look at the timeline, I bought the 8 unit. My wife and I bought the 8 unit, so just us. We bought an 8 unit building, and the next property we acquired was 192 units. Now, seems like a massive jump, right? Part of it is we were general partners. We partnered with other operators who had a little bit more experience than us, and we brought in some investors as well in that deal. So it's not like we just went out there and bought 192 units by ourselves. But when we open up to this notion of partnership and working with other people, it allowed us to scale. So we have a slice of the pie as opposed to the entire pie, which is what we were doing up to that point. But it also allowed us to leverage our network and, really focus on the things that we can do well and continue to get better at those things, as opposed to trying to be a jack of all trades.
Now, are you investing mostly in like the Ohio markets and like the Midwest? Is that where your bread and butter is?
Well, that deal was in Texas. We do like the Midwest. We particularly like a 2 hour radius of Cincinnati. So we focus on Cincinnati, Louisville, Kentucky, Indianapolis, Dayton, Columbus. We like those markets a lot. But we do focus on the Southeast as well. And our strategy is, we focus in that 2 hour radius for deals that we're going to be kind of leading, but we will partner with other operators in deals that are in that Southeast region. So we like Florida. We've got stuff we've done stuff in Texas, and we like Georgia a lot. We've done in the Carolinas. We've got another property in the Carolinas. So we like those markets. But for me, it's a matter of where can we be strong and be smart and be effective and efficient with our resources and our time. For me to try to go out there and compete with all the other investors in Atlanta or San Antonio or Charlotte and in my backyard, it's just not realistic that I'm going to be able to stand out and be competitive or great in all those different markets and keep track of all the dynamics and all the ins and outs and all the broker relationships. So for us, it's a matter of focus on home base, which for me, home is that 2 hour radius, and then partner with people who are in these other markets. That way, we're taking our time to get to know them. We're vetting them. We understand the way they look at deals. We have already built up kind of a comfort level with them. So by the time there's a deal or an opportunity that we want to be a part of, all we really have to do is look at the deal, understand the business plan, and decide whether or not we're going to partner.
Yeah, that makes sense. As I talk to more and more multifamily syndicators, it seems like kind of like what you have to do. So I've never syndicated a deal. I've only done, I've done a lot of house flipping. I've done a lot of single family and duplex, triplex, fourplex acquisitions. Matter of fact, I just bought a duplex and I'm buying a fourplex at the end of the month here. But I think what I've learned from all my mentors, and a lot of them, like a guy, Vinny Chopra, I do a show with Vinny Chopra. He owns a lot of units. You probably know who he is. He thinks bigger than probably I do. And it was all like, he showed me his progression. It's just like truly amazing. I think you really start seeing it. And then it's like, it's hard to go back. Now, now that you've experienced and you've grown your portfolio in the syndication world, do you look at kind of smaller deals that you just do yourself now, or you just like sold kind of on that model and you don't really want to do like a 30 unit yourself, or do you just kind of want to stay with the syndication model? Do you just like it that much better now?
We primarily focus on the syndication model. I mean, that's the bread and butter of the business. We're open to smaller deals, but I think it comes down to where do you want to spend your time. If I'm spending my time chasing anything, then what does a deal look like for me? So I think part of it is you want to get clarity on what a deal looks like. There's certain requirements that you need to have in order to be liquid with assets and things like that. So it kind of helps to make sure we're funneling most of the stuff in the deals that we are going to work with other investors on. But we like that. I want to quickly go back though to what you just said. You talked about smaller deals of what you're focused on, right? 2, 3, 4 units. Nothing wrong with that. But I also think that when you talk about that big picture mentality, a lot of that comes from how you take care of your mental, whether or not you have a formal mentor. Do you have someone that you're spending time around? Who are the people you're surrounding yourself with? Are you having conversations like this that can help you level up? If I were to tell you, hey, that 4 unit you're getting ready to close on, you can add a 0 to it and not have to bring more money out of your pocket. Would that interest you, right? And you can maybe double the equity you can get. And if you can understand that that's not just lip service, there's plenty of people who are doing that. It broadens your horizon. And for me, I kind of came into real estate investing feeling like you build your own portfolio with the money you got. The only other investment you get was from a bank, right? Like you buy a property, because I wasn't flipping. It wasn't a hard money. We did some flips, but we didn't start there. I started with the 2 unit. I saved up 50K, ended up not needing all the 50K to buy it. We bought the property. We put the money back into it, fixed it up, saved up more money. We bought a 3 unit property with our money, right? We refinanced that first property, used that and some savings to buy the 8 unit. And that's how I was building. And I remember talking to people and they were like, dude, the people who were very successful and who had owned or managed hundreds of units, they looked at me and said, dude, why are you doing it that way? But the people who were behind me or kind of that same space were like, oh, that's great. And I think I just started to look at the other people who were ahead and saying, and in particular, again, my friend who went from 9 to 90 in particular, that was within about a 12 to 15 month time frame. And I was like, how is that possible? Like I knew you at 3, and I saw you go from 3 to 9. And I thought that was incredible. And you went from 9 to 90. So we sat down, and when she explained the how, it really broadened my horizons. And I say that because I think it's very important for investors to be aware of the opportunities and to make it real. Because I mean, listen, for as far as you're concerned, I'm just a dude on this podcast. You don't know me. You don't know me. You don't know much about me. You can Google and you can learn things about me, but you likely haven't met me in person, shake my hand, look me in my eyes. Same thing with books, right? You read these books, these blog posts, these are just random people. So it doesn't feel real. It doesn't feel tangible. It doesn't feel like it's something I can actually do. I remember reading one of Robert Kiyosaki's the books, The ABCs of Real Estate, right, with Ken McElroy. And in there, he talks about your first deal doesn't have to be a 2-unit or a 4-unit. It could be a 100+ unit building. And I just like, dude, are you out of your mind? Nobody's first deal is going to be a 100+ unit building. And I didn't know what syndication was, right? It just didn't make any sense to me. And I just thought it was the most ridiculous statement I've read. And you understand, okay, yes, maybe not by yourself, but you can partner, you can team. There's a way to chop down this tree as opposed to trying to do it all by yourself. And I just think it's really important to understand the mentality of you have to figure out what you want. And one thing that happened with me in my portfolio when I got up to, the 8-unit property, we started doing a couple of flip projects. And part of the reason I wanted to do all this was to insulate myself from losing a job, but primarily so I could be around my family, right? And I could take care of my future and control that future. Well, I had my first son, and I remember there was a Saturday afternoon, and I spent that entire day painting a unit, right? Just the painters quoted me something crazy high. I wasn't feeling it, said I'll do it myself. It took me 8 hours. I was there for 8 hours, priming the walls, washing the wall, everything you do to paint the right way. And I just remember saying to myself, dude, you said that you were doing this to create financial freedom, to insulate yourself from, the need of a W-2 job. And you're here working a second job. What do you mean? You're like, you just took on a second job. You're missing out on your family. My family's at the park. I'm here on a 90-degree day painting inside. So I say that because when you understand what your real goals are, it helps you get creative on how to find the right solutions, as opposed to you just feeling like you got to do it all yourself. There are other ways, and syndication may be one of those ways. And if I could go back, that's probably where I would have started, because I would have started on the LP side. I was a busy professional. I just had my first kid. I already had my own small rental portfolio I was trying to manage for myself. To try to now build a syndication business, I was starting to stretch myself too thin. And I think it's really important for people to understand what their priorities are and prioritize those priorities. If being with your family, being a present parent is a priority, make sure you're creating a life where you can do that. If building as much income and wealth as you can today is a priority, then make sure you're doing that. And there's not a right or wrong answer. It's about you, but just make sure you're creating that opportunity for you to create the life you're looking for.
That's some really good advice. Being in the loan business, and I fund all investors pretty much is what I do. And what's interesting is I'm sitting there watching these investors just grow their portfolios. And sometimes I'm kicking myself, just going, okay, yes, I'm buying some assets, but I looked at, I helped this gentleman close on his largest deal, which was like 90, it was a 98-unit property in Texas. And we closed with bridge money because it was a value add play. And I watched this guy in 18 months. I think he went from 23 units to like 320. And, it's just the power of learning capital raising and syndication. And like, I got started I'm 44. I got started in real estate at the age of 20 doing residential lending. And I got good at, making loans. And then all of a sudden I realized I can buy property. They were giving money out at this time. This was 2005, right? So I was a dumb young kid, and
I started.
Yeah,
they gave you a loan. As long as you could breathe, you got a loan, right?
And that was good because I knew I did that for a living. So I started buying all these properties. Anyways, we all know what happened in 2007, 8, 9, and I always say I went through an early midlife crisis, and that's kind of put a little bit of a kind of a reserve on me, where you always have that thing in the back of your mind where you're like, you like that. I felt that stress, and a lot of newer people that weren't in the space in that time, they haven't experienced. I mean, that was really like, I don't think that's going to happen again anytime soon, hopefully. But that was a terrible time in a lot of people's lives who were in the real estate space. All my friends are mortgage brokers, real estate people. It was very difficult. And I think that still hinders me a little bit, right? Like that kind of like that thing in the back of your mind where, you have that in there. And so, but obviously I wasn't educated on cash flow and why I'm buying these properties. I was just buying for pure, on the West Coast, appreciation and speculation. And I was buying in areas that got hit the hardest. So it's kind of, I'm glad it happened to me at an early age, because I feel bad for the people that were in their 50s and 60s and they lost everything. And that was it. I mean, people forget how bad it was for a time period, but resilience is the key. And so, I know, like, it was a good learning lesson for me. And that's why I'm like, but I do think now in my level, I need to level up a little bit, right? Like I look at some of these people I'm funding and I'm like, okay, well, why aren't I doing this? I have a lot of skill sets, right? I underwrite these deals. I understand how finance works. So it just makes sense for me to progress, whether it's some kind of larger JV or syndication, because really that's how you can grow quicker, faster. And it actually makes a lot of sense. If I'm buying property on the East Coast right now and it's only a fourplex, and it's like, I got to have a property manager. When you're buying a 150 unit building, you're having professional management. It's more of a high level investment where you're probably actually working a little bit more strategic than you are on these. If you have, a portfolio of 40 rental properties scattered throughout, that's kind of a pain. So I get the principles behind buying larger properties totally makes sense. So really it comes down to a mindset shift. And I think that's exactly what I heard from you. So thank you for pointing that out.
You're listening to the Investor Financing Podcast. We'll be right back after this break.
Hello, Beau here, host of the Investor Financing Podcast. Are you a lender, real estate professional, or vendor that provides products or services within the real estate investing and business owner space? We are offering a few sponsorship opportunities to get in front of a highly targeted audience. If you're interested, please click the link below for further information. We look forward to talking with you. Thanks. Make it a great day.
Let's talk a little bit about, like I noticed when I went to your website, your marketing background is really, you have a really nice website. You have that eye, and you understand the marketing component. So what does your business look like now? I see you also mentor, so that's great. You're helping other investors that want to get into multifamily. And what I like about the multifamily space is what I heard you say is, listen, you can come in as an LP early on, learn the business, right, from the LP side. And also a lot of people that have money and they're working their 9 to 5, they don't have the time or experience to do it. And I think that's just a tremendous way. If you have 50, 100, 200 grand, you can come in as an LP and learn from the operators. So like, will you kind of talk about what your business looks like? I'm sure you're spending a lot of time with newer investors that maybe have capital and they want to invest. And then what does that process look like for you? And how are you growing your business today?
Yeah. So, I mean, as of right now, we've got, we've invested in over $100 million worth of apartment buildings. We've sold a little more than half of that at this point over the last, really 12 to 18 months. We've when COVID hit, I think we took a look at our portfolio. When things settled down, market was still hot, demand was strong. So it was a great time to kind of reposition that portfolio, sell some of the properties where we've maybe implemented most of our business plan, or, quite frankly, we could exceed our projections earlier in the cycle, but also then to turn around and invest in newer, higher quality assets, as opposed to holding on something that was a little bit older, right? So that's part of what we've been able to do. As far as the way our business works, you're right. We work with everyday professionals who are looking to get the benefits of real estate investing without the headaches of being a landlord. And your point on the scale, I think, is really important, because on the surface or intuitively, it may feel more risky to invest in a 100-unit building, right? hey, maybe I just want to do a 2-unit. Let me do this duplex. The 100-unit feels like it's just too much, a lot going on there. Here's the challenge. When you do a 2-unit, you're probably doing it by yourself. Even if you hire a property manager or someone to oversee it, your margins are extremely thin because you only got 2 units. There's only so much revenue you can generate with 2 units, right? If you don't have a lot of experience, then you are prone to make mistakes. If you have a unit go vacant, or you have a furnace go out, or you have a roof leak, or whatever the case may be, it could wipe out an entire year's worth of profits. So there's actually more risk in owning a smaller property than on a larger property. Let's go back to the 100-unit building. If you have a 100-unit building, you are anywhere between 0 and 100% occupied. You have a 2-unit building, you're either 0% occupied, 50% occupied, or 100% occupied. There's no in between. On that 100-unit, you're probably going to maintain something between 90 and 96% occupancy. Maybe it dips down into the 80s at some point, but you're going to maintain occupancy at a certain level. And because of that predictability with the scale, you can run it like a business. And this goes back to what we talked about before with my corporate background. If I can anticipate and forecast that we're going to have between 92 and 95% occupancy each month, I have a pretty good sense of my revenue. And I'm not worried about a resident leaving or moving out, or us trying to push rents. We got enough scale where we know what levers we can pull. If a big ticket item comes up, well, that's going to happen. We're going to replace some furnaces. We're going to have some hot water tanks that go out. We're going to have some, appliances that go out. You anticipate and expect that. Sure, 1 month might be higher than you would expect, but maybe the next month it's a little bit lower. But you're anticipating that because you can. It's enough scale where you can anticipate these ebbs and flows, just like any big business would do. So it actually becomes a little bit easier to run it like a business because you have projections, you have the estimations or in the forecasting of what you can anticipate. You have larger property management companies that are used to managing these larger properties. They've got experience managing thousands of units and understanding how to manage unit turns and what tenants are looking for in a unit finish. They've got all that experience versus, again, if you're running this 2-unit by yourself, maybe you're self-managing it. Well, how many units have you rented? How many leases have you signed? Maybe you do bring in a property manager. Well, what's that property manager's experience, right? They probably manage 10, 15, 20 units versus a company that manages thousands of units, and they have systems and processes and vendor relationships and discounts and things like that in place. So it actually becomes more professional. The lending side of it, as you know, becomes more professional because people are way more willing to lend tens of millions of dollars, as opposed to $200,000. It's just the way the game goes. So the bigger you go, the easier it actually becomes because you have scale. Last example, if you're looking at a business that you want to invest your money in, one of the reasons people like the stock market is because these businesses are huge, right? You got a big company. There's a clothing company, how huge Nike is. So if you put your money in Nike stock, yes, it might ebb and flow, but it's not going to zero. But if you just launched a brand new shoe company, I mean, the chances of that spiking up or dropping to nothing, are a flip of a coin. So it's the same thing, right? If you've got a small property, the ebbs and flows are wilder. If you've got more units, if it's more professionally managed, you have a little less risk because of that.
Yeah, that makes sense. It's funny. My aunt is buying a new house, and she's selling a house, and she's buying a new house, and her house is free and clear. And she's like, well, should I get the appraisal done on the new house? Because she was going to go, it's a brand new home. And I'm like, yeah, you should do it, even if you're going to pay cash. And I said, but wait, like, you probably shouldn't pay all cash. You should take your money, or at least half that money, and invest it. And she's like, well, I just put my money in a money market. I'm like, are you serious? I'm like, are you even getting 2%? Right. And she's like, no. And here's a lady that she saves everything she has. I don't know how much she has, but I imagine it's significant because she's just very frugal. And I'm like, I was just trying to explain to her, I'm like, with inflation and you're putting something in, you're getting less than a 2% return. It's like, I mean, it's just amazing that people are out there. Sorry, Aunt, but I'm just like, go put that in something ultra secure, but you can get a way better return than 2%. You can invest in like trust deeds, or you can be in a very good syndication. And she's just so concerned about risk. And I'm like, well, to be honest with you, you're losing money. If you're getting less than 2% and you have a boatload of money in there, I just don't understand that people don't realize this. But, to her, this is her security because she's going into retirement years and stuff. But it's like, that's going to be, you're losing money. She's losing money by putting it in this money market. Yeah, it's crazy.
Though I think the thing that's wild, and this goes back to the mentality, right? We talked about raising money a little bit, but what really crystallized things for me was realizing that I could help other people like your aunt, right? Because there are people who are putting money in these savings account, money market accounts, making less than a point return right now. And these people are losing money with inflation going up the way it is. And if you're making money doing real estate, and you've been in this for over 20 years, right? On the lending side, at least. If you're making money doing real estate and you've got someone in your family who, is essentially keeping money under a mattress, like, don't you want to help them? And telling them what to do is one thing. Providing an opportunity for them to join you and make money alongside you is something completely different. And for me, it just became a more important task to say, you know what, I can't help everybody, but if I'm going to be investing in real estate and it's working for me and we're growing our portfolio, we're growing our net worth, let me create an opportunity for other people to join me. And that's exactly what happened, because I was telling people to do, hey, this is how you do it. Go find you a property, go house hack. I tell everybody, go house hack. If you don't have kids, go find you a 2 to 4 unit property, live in one unit, rent out the others. It's a great way to get started. No one did it. No one I knew did it. Right. But you share what you're doing and you make it easy for people. Well, they're more willing to invest that way. And ultimately, it comes down to how can you help the people around you? And if that's one way you can do it, now you're adding value, and it becomes less about raising money or whatever you want to call it. And it's really more about serving the people in your network, right? And if you can do that, now you've got a service that you're offering. Yes, it's a business, but you're truly adding value to other people in the same way that whether it be a money market account or different advisors have, and to partner alongside us on our deals, that's a great value for a lot of people.
Yeah, no, totally. My good friend got into buying Airbnb properties. I gave him a course on it, and he took off. He excelled in like 18 months. He got 5 properties. He can live off the cash flow easily. He's crushing it. And then I'm like, okay, here, talk to this guy. You should look at doing cost segregation on these properties, because even if you're not a real estate professional, there's a loophole if you buy these short. And he did it. He's had like $200,000 tax savings. Obviously he's got to recapture that, but it's just amazing that this stuff is what everybody should know, and it's just not mainstream. And that's the importance of my podcast, your podcast, is to like, hey, it's peer to peer, right? Peer to peer is the way that people are going to actually learn about strategies. And I get a lot of calls from new investors. Hey, I want to buy my first investment property. And I try to help them as much as I can, right? And sometimes it's just some people are completely lost, but I think that there's enough good information out there that they don't necessarily have to pay for it at first, right? Eventually, once you understand learning, you're going to probably go and pay a coach in one way or the other, right? You're going to pay a coach. You can learn for free, but I believe like you should start online and learn. And then once you know enough, you find the right mentor, and then you learn from them. But yeah, I just think it's kind of our duty to like help some of these people. And even I have somebody in my family, he's very successful, W-2, high wage W-2. And it's like, he's paying $300,000 or $400,000 a year in taxes. And I'm like, man, there's strategies that you need to be looking at. And, he's a really smart guy. He's in the, financial service industry, but he just doesn't look at real estate. I'm like, you got to think real estate. Look how much appreciation you've made in just equity in real estate you just bought but to live in. And just imagine if you actually thought about it and treat it as a business, and like people don't do it. But I really liked how you brought up looking at it's a business, and you take it seriously, and that's how you were able to grow your portfolio so rapidly. And I can just tell got a lot of good nuggets from this conversation. Where can people find out more about you? Where should we send them?
Yeah, listen, I mean, I think it's really important to be able to take a look at a deal, understand what you're looking at, and, get to the point where you can find deals that you want to invest in, whether you're active or passive, right? On the active side, certainly if you're going to raise money and try to bring on other investors, you got to get sharp. You got to make sure you know your stuff, that you get educated. You talked about mentorship. So all those things are very, very important. We've put together a sample deal package on our website. I think it's a great way to start. You can download that at kasmancapital.com/sample deal. If you want to be active, take a look at it, learn what kind of information you need to have, that you would need to understand before you start sharing a deal with other investors. And if you want to be passive, or you're interested in at least, letting somebody else drive the bus for a minute while you get started and get comfortable, download that sample deal package as well, because it'll give you a chance to learn what kind of questions you should be asking, what kind of things should you be looking for, how are deals structured. And there's a lot of different variations in there, but it's a great place to get started. So you can download that at kasmancapital.com/sample deal. And then also check out our podcast, Multifamily Insights. It's available anywhere you listen to podcasts. And as you said, Beau, you got to educate yourself, listen to shows like this, start to wrap your head around the mindset that's necessary, and then start getting into some strategies and figure out what path is right for you.
Yeah, that's awesome. Awesome advice. And I was just thinking as you were talking, I'm like, really the ultimate investors are people that have enough cash where they don't have to be the operator. They can just invest passively. Like, honestly, if you really look at what people do, if you have money, like, for example, if somebody's flipping a house and you're the money partner and you're making 30% of the profits by doing a profit share with it, like, you're the money. Like, being the money is the best part, because you don't usually have the headache you do as the operator. And like, the operator is the one doing all the work, right? He's putting the deal together. He or she is sourcing, figuring it out, doing the value add component. So I think, ultimately, like, what I was just envisioning is really, it would be great to have enough capital that I could just deploy with the right sponsors and operators, because then I could truly be really passive. And I think if anybody's listening that has money, that's where you really want to be, is that you don't want to be the operator. Sure, you for dollar in, you make a huge return and it's attractive, but you also have all the stress of the deal on you, versus like, if I had a couple $1,000,000 and I could just deploy that into different syndications, that's a way better way to go. I mean, you talk about ultimate time freedom. All you're really doing is vetting syndicators and sponsors and looking at the deal. I mean, ultimately, like, that's my big takeaway here, is that's really where you want to go. The money lenders of the world, and being and having the capital to invest in deals and not be the operator that's like the best place to be, I think. Yeah. Really,
I mean, think about it, right? I mean, you're on the lending side, banks, right? Banks, they're the ones making the most money, right? I mean, you take this money, you lend it out. You have no risk, really, right? I mean, worst case scenario, deal goes bad, you take the property back, and then you lend the money or to someone else to go do the property, right? So they're not out there doing the work. They're sitting in the office figuring out, hey, do the numbers look good? Okay, great. We'll loan the money out. We'll get it back. So to your point, yeah, I mean, the ideal place to be is a place where you can invest your money and let your money work for you, as opposed to you having to go work for the money. Going back to me being in that apartment building on that hot Saturday afternoon, that's when I realized, nah, you don't want to be here. You'd rather be either the guy hiring the people to do it, or even better, you're the person invested in the guy hiring the people to do it, so that you don't have to worry about any of that. You just collect your checks. And that's really the best place to be if you're investing in it. It's particularly, as you said, if you have other things you're doing, if you're a high income earner, it's the best way to get it. Don't try to do all this by yourself and waste your time starting at ground zero and then building up from there. Focus on folks who have that experience, who have a little bit more knowledge, and invest in them and partner with them on those deals.
That's so awesome. I was kind of smiling in my head. I have to just tell you a story real quick. My wife's from Mexico. I met her when I was traveling in Mexico, and then she moved here. And so she's used to, where she's from, and she's from a small city in the state of Jalisco. And I try to explain to her, like, she wants me to go mow the grass or or do that. And I'm like, well, why don't we just pay somebody to do that? Because it's going to, it's a lot easier. They're going to do it in an hour. It'd take me 3 or 4 hours. It's still not going to look as good. I'd rather pay them the $80 to do that, because in that 2 or 3 hours of me being frustrated, I can make a lot more than $80. And I always try to explain it to her. So it was just cracking me up in my head. Like, it's so true. Like, why would I want to paint? Like, if I enjoyed it, it'd be one thing, but like, I would rather just not, and just, it's a cost. Okay. It's going to take them a day, and it's a crazy amount of money. Like right now, the labor shortage, right? The HVAC, everything, plumbing, they charge you an arm and a leg. But at the end of the day, like, if I had to take a day off just to do that and not be able to, it just doesn't make sense for me. So I love looking at things. Everything I look at is like, okay, what's the return for me, whether it's time or money. And then I'll outsource everything if I can. I mean, that's why I have virtual assistants in the Philippines, because they can do a lot better job than I could if I try to edit this podcast, right? I know people that still edit their own podcasts. I'm like, wait a second, you can go get somebody that's highly skilled at video editing, and you're doing it, and you're can build like an attorney bills, and it just doesn't make sense. People don't realize that sometimes, and it's just crazy.
Yeah, I mean, take it back to business, right? I mean, if you have a business and you're the accountant, you're also the attorney, you're also, the sales lead, you're also the product engineer, you're the HR person. How effective do you think you can be wearing all those hats? Even in marketing, you just pick one role. Okay, you're marketing, you're writing copy, you're identifying guests you want to get on, you are, promoting each episode, you are finding deals, you're talking to owners, you're putting out direct mail campaigns, you are posting your social media content. I mean, how good can you actually be, and how consistent can you be when you're wearing 22 hats? So you've got to figure out what you can do well. And then, yes, you need to figure out how to delegate, build a team around you, just like any business would do, any job. They're all built on how do you scale. I mean, if you're a chef, you're a class A chef, you can't cook all the food yourself for the entire restaurant, no matter how great you are, right? So it's not really about skill. You've got to be able to delegate, put some people around you who can scale. And that goes back to, why large multifamily is better than small multifamily. On a 2-unit, you can't afford to bring in all those other people. There's not enough money to go around. But on a 100-unit, you can. And that's the difference.
That's awesome. Well, everyone, I hope you guys got a lot of nuggets out of this. I love hosting these interviews because I always get so much out of it. And I do it selfishly. And I also know that it's providing tons of value. But every conversation I have with somebody out there, it opens my mind to something that I'm not looking at. And if you guys just, every podcast you listen to, just get one nugget out of that podcast and move the needle just a little bit every day. It's just amazing how you can just grow and learn so much. And really appreciate your time, John. It was a great conversation, and hope to have you back on the show at some point.
Absolutely. Thank you, Beau. Thank you for having me today.